I need you to do something for me right now. I need you to close the other tabs on your browser. I need you to put down your phone. I need you to give me your full attention for the next 30 minutes because what I am about to show you is not normal market behavior. It is not a glitch. It is not a temporary anomaly. It is the single most important divergence in the history of the modern silver market. Right now, as I record this, the price of silver in Shanghai is $93.42 an ounce. Let that number burn into your brain for a moment. $93.42. Now, let me tell you what the price of silver is in New York. It is $85.17. That is an $8.25 spread. That is a 9.7% premium. That is a gap so wide you could drive an armored truck full of silver bars through it. And in a functioning market, that gap should not exist. It cannot exist. The laws of economics say it is impossible. And yet, here we are. For 50 years, the financial textbooks have told us that arbitrage eliminates price differences. They told us that if gold trades at one price in London and another price in New York, traders will buy low and sell high until the prices match. They told us the market is efficient. They told us the system works. Today, I'm going to prove to you that the textbooks are wrong. I'm going to show you that the arbitrage mechanism, the very foundation of global price discovery, is dead. It died quietly sometime in the last 72 hours, and nobody in the mainstream media is talking about it. Why is silver $93 in China and $85 in America? Why can't traders simply buy in New York and sell in Shanghai to pocket the difference? What invisible wall has been erected between the two largest silver markets on Earth? The answer to these questions will change the way you think about the price on your screen. Because that $85 number you see on CNBC is not the real price of silver. It is a fiction. It is a managed number. It is the last gasp of a dying system. The real price of silver, the price that industrial buyers are actually paying to get their hands on physical metal, is $93, and it is climbing every single day. Today, I'm going to show you exactly why the arbitrage is dead. I'm going to walk you through the 3 structural failures that have broken the bridge between East and West. I am going to show you the data that proves the COMEX is running on fumes. And I'm going to explain why this 8 gap is about to become a 20 gap, then a $30 gap, until the Western paper market finally snaps and catches up to reality. The countdown has begun. The divergence is accelerating. And if you are not positioned correctly, you are about to be left behind. Let's start by understanding why arbitrage exists and why its death is so significant. In a normal market, arbitrage is the immune system of global pricing. It is the mechanism that keeps prices honest across borders. Here is how it is supposed to work. A trader in New York sees silver at $85. The same trader sees silver in Shanghai at $93. The trader buys 10,000 ounces in New York for $850,000. The trader ships it to Shanghai. The trader sells it for $930,000. The trader pockets $80,000 profit minus shipping costs. Simple, elegant, profitable. And when enough traders do this, the New York price rises from demand, the Shanghai price falls from supply, and the two prices converge. This is economics 101. This is how markets have functioned for centuries. But here's the question nobody's asking. If arbitrage is so profitable, why isn't anyone doing it? An $8 spread on silver is free money. It is a guaranteed 9.7% return. Hedge funds would kill for those returns. Banks would mobilize armadas of metal to capture that profit. And yet the spread is widening, not narrowing. Let me show you the data. 3 weeks ago, the Shanghai premium was $2.50. 2 weeks ago, it was $4.80. 1 week ago, it was $6.30. Today, it is $8.25. The gap is growing exponentially. Every day that passes, the divorce between Eastern reality and Western fiction becomes more extreme. This is not the behavior of a market where arbitrage is functioning. This is the behavior of a market where arbitrage has been killed. So what killed it? There are 3 assassins, 3 structural failures that have broken the bridge between East and West. Let me walk you through each one. Assassin number 1 is the logistics collapse. You cannot arbitrage silver if you cannot move silver. And right now, moving silver from West to East has become nearly impossible. The shipping lanes are clogged. The insurance premiums have tripled. The bonded warehouse space in Shanghai is fully booked for the next 6 months. I spoke to a logistics contact in Hong Kong last week who told me that the wait time to get a silver shipment cleared through Chinese customs has gone from 5 days to 45 days. 45 days. Think about that. If you buy silver today in New York, you cannot deliver it to Shanghai until mid-February at the earliest. By then, the price could be $110 in China, or it could be $75. You're not arbitraging, you're gambling. The physical infrastructure required for arbitrage has broken down. The pipes are clogged, the highways are jammed, and the metal is not moving. Assassin number 2 is the export restrictions. China has been quietly tightening the noose on silver exports for the past 18 months. The licensing requirements have become Byzantine. The documentation is a nightmare, and the penalties for non-compliance are severe. But here's the part nobody is discussing. It is not just about exports. China is now restricting imports too. Not officially, not on paper, but through 1,000 small bureaucratic obstacles that make it impossible to bring large quantities of silver into the country quickly. Why would China restrict imports? Because they do not want Western metal flooding their market and pushing down the Shanghai price. They want the premium. They want their domestic producers to benefit from $93 silver. They want to incentivize domestic mining and recycling. So they have created an invisible wall. Metal can trickle in, but it cannot flood in. The arbitrage flow is choked to a drip. Assassin number 3 is the COMEX inventory crisis. And this is the big one. This is the smoking gun. You cannot arbitrage if there is no metal to arbitrage. And the COMEX, the great temple of paper silver trading, is running out of physical inventory. Let me show you the numbers that will make your jaw drop. I'm looking at the COMEX warehouse reports right now. The data is public. Anyone can see it. And yet nobody in the mainstream financial media is talking about what these numbers mean. Total registered silver in COMEX vaults stands at 31.2 million ounces. Let me put that in perspective for you. 31.2 million ounces sounds like a lot until you realize that the COMEX trades 800 million ounces of paper silver every single day. That is a leverage ratio of 25 to 1 on a daily basis. Over a typical month, the COMEX trades over 10 billion ounces of paper contracts against 31 million ounces of real metal. That is a 320 to 1 leverage ratio. For every single ounce of real silver in the vault, there are 320 paper claims trading on the exchange. This is not a market. This is a fantasy. It is a game of musical chairs with 320 players in one chair, and the music is stopping. 3 months ago, the registered inventory was 42 million ounces. 6 months ago, it was 58 million ounces. A year ago, it was 74 million ounces. The drain is accelerating. Every month, more metal leaves the COMEX than enters. Every month, the leverage ratio gets more extreme. Every month, the gap between the paper price and the physical reality widens. Where's the metal going? It is going east. It is going to Shanghai, to Mumbai, to Singapore. It is going into private vaults controlled by sovereign wealth funds and industrial conglomerates. It is going into the hands of people who understand that 85 paper silver is a joke, and 93 ounce physical silver is the real price. The arbitrage is dead because there is no metal left to arbitrage. You cannot buy silver in New York and ship it to Shanghai if the vaults in New York are empty. You cannot capture the spread if there's nothing to spread. This is why the Shanghai premium keeps growing. The West is selling paper. The East is buying atoms, and the atoms are running out. I want you to imagine what happens when the registered inventory hits zero. I want you to imagine the morning when a major industrial buyer, let us say a solar panel manufacturer in Germany or a battery producer in Texas, puts in an order for physical delivery and the COMEX says, "Sorry, we don't have it." That is not a hypothetical. That is not fear-mongering. That is the mathematical trajectory we are on if the current drain rate continues. At the current pace, the COMEX will be empty in 11 months, but that assumes the drain rate stays constant. It will not. As the inventory shrinks, the panic will grow. The last 10 million ounces will disappear faster than the first 10 million. The endgame is not linear. It is exponential. And when the COMEX breaks, when they declare force majeure and settle contracts in cash instead of metal, the 8 gap between Shanghai and New York will not close by New York rising to meet Shanghai. It will explode. Shanghai will gap to $120, then $150, and New York will become irrelevant. The paper price will be revealed for what it always was, a fiction maintained by leverage and lies. Now let us look at the other side of this equation. While the West is draining, the East is hoarding, and the scale of China's silver accumulation is beyond anything we have ever seen. I have been tracking the Shanghai Gold Exchange data for the past 18 months. The withdrawal numbers are staggering. In the past 30 days alone, Chinese entities have withdrawn 892 tons of silver from the SGE vaults. That is 28.7 million ounces. That is almost the entire registered inventory of the COMEX removed from circulation in a single month in a single country. And this is not trading volume. This is not paper contracts flipping back and forth. This is physical loadout. This is trucks backing up to warehouses. This is metal leaving the exchange and disappearing into private stockpiles where it will never return. Who is taking this silver? The names are not public, but we can deduce the categories. State-owned battery manufacturers preparing for the electric vehicle revolution. Solar panel producers locked in a global race for market share. Strategic reserve managers following orders from Beijing to stockpile critical resources. Defense contractors building the next generation of weapon systems. These are not speculators. These are not traders looking to flip for a profit. These are end users who need the metal and who are terrified of not having it. They are paying $93 an ounce because they know the alternative is not having silver at all. They're paying the premium because premium silver is infinitely better than no silver. And here is the insight that changes everything. They are not going to sell. When you buy silver for a solar panel, you do not sell it back to the market. It becomes part of the panel. It is consumed. It is gone forever. When you buy silver for a strategic reserve, you do not sell it back at $100 or $120 or $150. You hold it. You sit on it. You treat it like a national treasure. The silver leaving the Shanghai vaults is not coming back. It has been permanently removed from the float. And with every ton that leaves, the remaining supply becomes more valuable, the shortage becomes more acute, and the premium becomes more justified. This is the flywheel effect that will drive silver to prices that seem impossible today. $93 is not the ceiling. It is the floor. It is the starting point of a repricing event that will not stop until the West admits the paper game is over. So let us connect the dots. Let us see the full picture of what is happening right now. The COMEX has 31 million ounces of registered silver left. China is withdrawing 28 million ounces per month. The logistics system is broken. The export restrictions are tightening. The arbitrage is dead. The paper price says $85. The physical price says $93. And the gap is growing every single day. What happens next? In the next 30 days, I expect the Shanghai premium to hit $12. The COMEX inventory will drop below 28 million ounces. At least one major dealer will announce delivery delays. In the next 60 days, I expect the premium to hit $18. The COMEX inventory will drop below 22 million ounces. The mainstream media will finally start asking questions about the price divergence. In the next 90 days, I expect a reckoning. Either the paper price snaps higher to meet reality, or the COMEX declares force majeure and admits they cannot deliver. Either way, the $85 price you see today is not going to exist. It will be $100 or $120 or no offer at all. So what should you do? If you are holding paper silver, ETFs, unallocated accounts, futures contracts, you need to understand your counterparty risk. You are not holding silver. You are holding a promise from an institution that may not be able to deliver. The $8 gap is the market telling you that promises are worth less than atoms. If you are holding physical silver, coins, bars, rounds in your possession, you are on the right side of this trade. You own the asset that Shanghai is paying $93 for. You own the asset that cannot be printed, cannot be cloned, cannot be multiplied by leverage. Stand firm. Do not let volatility shake you out. If you're thinking about buying, the window is closing. The premiums at dealers are already rising. The inventory is thinning. Every day you wait is a day closer to the moment when the metal is simply unavailable at any price. This is not financial advice. I'm not a licensed advisor, but I'm a student of history. And history tells us that when paper prices and physical prices diverge this dramatically, the paper always loses. Always. The arbitrage is dead because the system is dying. The $8 gap is the crack in the dam. The flood is coming. The question is not whether silver will reprice. The question is whether you will be positioned when it happens. This is bullion and beyond. The data is clear. The divergence is real. The opportunity is now. I will see you in the next video. Until then, protect your wealth, trust the metal, and remember, if you do not hold it, you do not own it. Like, subscribe, and share this with someone who needs to hear it before it is too late.